If you are looking to earn more on your investments, invest in number one, Sigma Global Funds, the top performing funds for Jamaica in 2021. For Jamaican dollar and US dollar equity funds, we were number one. For Jamaican dollar and US dollar fixed income funds, we were number one. Our US dollar and Jamaican dollar balanced funds were both number one. Don't settle for less. Invest in the number one funds in Jamaica, Sigma Global Funds.
Good evening, viewers. Welcome and thank you for joining us for the third staging of the Sagicor Investments Money Talks series. For the next approximately 2 hours, we will be engaging you on all things to do with geopolitical events and investments. If you're joining online via Facebook, Instagram, Sage, or Zoom, you can follow the discussion by using the hashtags, Money Talks, Sagicor Investments, Investor Briefing. Well, stay with us for an insightful evening, and of course, get ready to answer the social media giveaway question. But we're going to begin with the opening batsman this evening, the Executive Vice President and Chief Investment Officer of the Sagicor Group, Sean Newman. Sean, take it away.
Thanks, Cliff. Good evening, everyone. Dr. Wayne Robinson, Senior Deputy Governor, Bank of Jamaica. Mr. Christopher Zacco, President and CEO, Sagicor Group Jamaica. My dear friend, Kathryn Rooney Vera, Head Global Macro Research and Chief Investment Strategist, Baltic Capital Markets. Our event host, Mr. Cliff Hughes, CD, veteran journalist, news editor, and CEO Nationwide FM. Our friends joining us on the Sage Network, Zoom, and social media. Members of the media, ladies and gentlemen, good evening. I'm pleased to welcome you this evening as we discuss the global policy paths, economic and social challenges, outlook for financial markets, and investment opportunities for 2022 and 2023, and how geopolitical events such as those currently happening help to shape this. Indeed, there is no better time for us to examine this topic, as global events have certainly magnified the risk-reward trade-off. The world is holding its breath right now, waiting to see whether the COVID pandemic is really coming to an end, or whether we're heading into another global wave. While Jamaica is exiting restrictions, we see China entering more lockdowns. Anxiety is high when we look at the military action in Ukraine by Russia and what this means for not only the citizens of those countries, but on world trade. Concerns arise about energy availability as governments impose sanctions on Russia, which is a major exporter of oil and natural gas. Ukraine is a major supplier of wheat and grains to the global food market. So how will this affect food security? While many of us closely follow these events, such as those and the complex web of trade relationships that are formed and broken in their wake, we know that many investors, truly and understandably so, just want one question answered. How does this affect my investments? History has shown that pandemics, conflicts, and other events such as these have global implications, which in turn affect our economy and others in the form of rising consumer prices, energy costs, input costs, and prices of manufactured goods. So how do investors prepare themselves? That is what our expert panelists will be examining tonight. This special investor briefing is designed to provide pertinent information which can be utilized in navigating this period. We will also be reviewing the current climate and the lessons learned from historical events to discuss what silver linings and opportunities there are for investors. Sagicor Investments Jamaica remains unwavering in our dedication helping you, our investors, to create, grow, and preserve wealth. And we are always happy to equip you with information and guidance to do so. Ladies and gentlemen, welcome to Sagicor Investments Money Talk series. Be sure to save your questions for our panelists and please enjoy the proceedings.
Thank you very much, Mr. Executive Vice President Sean Newman, setting the context very well. Several questions, issues to grapple with. And let me introduce our panelists this evening. We're going to begin virtually with Head Global Macro Research and Chief Investment Strategist at Bultic, Kathryn Rooney Vera. And good evening, Kathryn. Are you there, Kathryn? Yes?
Yes, sir.
Good.
Hello, Mr. Hughes. A pleasure to be here with you.
And it's great to have you. Where in the world are you joining us from, Kathryn?
From sunny Miami, Florida.
Oh, good for you. Yeah?
yes, sir. It's a beautiful place to be.
You can get more of that right here in Kingston, Jamaica.
That's right. That's right. I look forward to it. One day I'll be back.
Very well. On set in Kingston, Jamaica, we have the Senior Deputy Governor of the Bank of Jamaica, or Central Bank, Kathryn, Dr. Wayne Robinson, and President and CEO of the Sagicor Group, Christopher Zaka. Gentlemen, welcome. Thanks. Good. But we're going to begin with Kathryn. It's been one hell of a day in New York. The U.S. Fed hiking interest rates. The market's reacting quite positively in some instances, but it's over to you. What are we looking at in terms of geopolitical events and investments from where you sit at Bultic?
Excellent. Well, hopefully you can see the presentation that I'm about to deliver. It's global macro perspectives. And here what we're looking at is where we are in the current economic cycle. And if you can see it, Mr. Hughes, I appreciate you telling me that you can actually see the presentation. Yeah. But the biggest concern that I have going into this year and this new rate tightening cycle is the risk of stagflation. Stagflation is defined as a steep economic deceleration to get to potential growth rates or below potential growth rates with sticky high inflation. The Fed has started hiking rates now at a rhythm of 50 basis points. That decision was taken today into an economic deceleration. Last year, of course, the United States will have exceeded 5.5% real GDP growth. And this year, I'm expecting economic deceleration to come significantly below 3%. This is a conservative estimate that you can see in the presentation right now. The Federal Reserve has to hike rates because inflation in the United States is about 8.5%, and the target is 2%. Now, the biggest concern is that even if the Fed were to hike 200 or 250 or 300 basis points, taking the federal funds rate from effectively 0 to effectively 2.5% by year-end 2022, the Fed doesn't control the entirety of the inflation basket. As you all in Jamaica will understand, energy prices are causing an intense amount of pain for a lot of importing nations and energy consumers. Gas prices at the pump are surging. Food prices are surging. Healthcare costs, rents, the housing sector, everything is on the up and up. The Fed does not control it all. So we are in a very difficult, very complicated economic situation here in the United States, where, Mr. Hughes, what we've seen the peak of the economic cycle. We are effectively in a deceleration, and we're moving into this fourth quadrant that you can see in the presentation, which is stagflationary. Now, some of my biggest concerns are with regard to consumption and services. Consumption is 2/3 of the U.S. economy on the demand side. On the supply side, it's basically a service-based economy, and both are showing downside risks. As you can see here, both business and consumer confidence have been plummeting, and this is primarily because of inflation. So if, as I forecast, inflation remains high, even though it does decelerate, consumer confidence will continue to move lower. And as consumer confidence goes, so goes consumption. Again, 2/3 of the economy is based on consumption. The good news here is that household leverage is historically low. Now, we do see a recovery in household leverage, but it's going to be unlike what we saw in 2008 and 2010, where we saw a lot of defaults, both on the household front and in the housing market. Now, one of the biggest risks we've seen year to date is with regard to oil prices. So what we tried to do within my research team was quantify the impact oil prices or the surge therein has on economic growth. And what we were able to do is a quantitative exercise that says for every 25% increase in the price of whether it be WTI or Brent, we can effectively expect that approximately 44 basis points, or almost half of 1 percentage point, could be detracted from U.S. economic growth. So, for example, were oil prices to remain at $110, $125, in that range, that would effectively be a $25 increase on average for the entirety of this year. Were we to have been expecting, to make the exercise simple, 3% growth, we could slice that down to about 2.5. So these are one of the concerns that I'm primarily looking at. Now, the Fed finds itself in a complicated position because inflation is high, way beyond their target of 2%, but the labor market is also red hot and the economy is decelerating. So the Fed has to play catch up. Inflation has already gotten way beyond the 2% target, and they have to do it on a double-barreled front. One, on rate hikes, and two, on balance sheet reduction. The Federal Reserve has increased its balance sheet to nearly $9 trillion. Now, what we heard today, Mr. Hughes and all of your audience, is that the Fed is going to start rolling off assets. These assets are bonds. So the bonds mature. The Fed is going to allow the maturity of these bonds rather than reinvesting the bonds. They're going to allow them to mature to the tune of $95 billion per month, eventually in a couple months' time. Just to put this in an order of magnitude, or kind of put it in a reference, this is double what the Fed did the last time around. It had to roll off assets off of the balance sheet. So the Fed has a double whammy of rate hikes and balance sheet reduction, which means that the 10-year Treasury yield is more likely than not going to continue to increase. So right now we're at about 3% on the 10-year Treasury. That's likely to break 3% and keep moving to the upside. We are expecting at least 200 basis points in rate hikes this year. Likely the Fed is going to get to 2.5%. What is the chief driver of inflation? We've all heard about oil prices and food prices. Sean Newman alluded to this effect when he mentioned that Russia and Ukraine are pretty much the breadbasket of the world. They produce 40% of all of the wheat that is consumed at a global scale. So turmoil in that area of the world does impact a lot of the grain industry. So we have food prices increasing, we have oil prices increasing, but we also have salaries on the rise. The US, as I mentioned, has a very red hot labor market. Today, the Federal Reserve President mentioned, I counted 3 to 5 times how hot the labor market was. And he specifically cited a number that I found interesting, which is that for every one unemployed person, there are 2 jobs available for that person. So until that number comes down, we're unlikely to see a recession, but rather we're likely to continue to see salaries moving higher. My suspicion is that by the end of this year, we are going to see real salaries outpace or salaries outpace the rate of inflation. Now, what the Fed wants to do here is decrease inflation expectations. They want to avoid the situation where inflation expectations get unanchored and they continue to move aggressively higher. So regardless of the fact that inflation is likely to move from near 10% to my estimate, which is about 4.7% by year end, regardless, the Fed is going to have to aggressively hike. One of the other risks that I would like to highlight in my brief comments here is the risk of additional exogenous shocks to inflation, specifically emanating from China. So we have oil prices going higher, food prices going higher, monetary stimuli that has been very aggressive and has likely exceeded its expiration date by a long shot. We've also had fiscal stimuli, which is very inflationary. But in addition to that, as we all know, there are supply chain distortions coming from Chinese economic closure. So what we've seen lately, and what I've been tracking very closely, is the 30-day rolling average of infections in China, and that is back up to about 1 million per 30-day rolling period. So if we get China resuming its economic closures, then we should expect additional scarcities within the global supply chain mechanism, and that will exacerbate what already is a very complicated inflationary environment. So that, I think, is one of the risks that we need to contemplate. So just to land all of these global macro themes and risks, what should we do with our portfolios? And this is something that I deal a lot with our institutional clients. So what we're recommending to clients, and we have been coming into this year, are sectors that outperform in the equity space, equity sectors that outperform in a stagflationary scenario, which is my base case for 2022. Stagflation ultimately will lead to recession. So in this chart, you can see the large cap real return, large cap equities in different inflation and growth environments. So as you can see, when we move into recession, large caps tend to underperform. So what we're recommending is going defensive rather than playing the cyclicals, of course, being the high flyers, technology, communication services, Google, Netflix, all of the big guys, moving into what is defensive. So value. Year to date, this has been an effective trade, and we expect it to continue. Now, this visual, I think, is the most important one of the presentation in terms of investment strategy. What are the sectors within the S&P 500 that outperform in different parts of the economic cycle? And what we concluded is that in stagflation or disinflation, you can bet on utilities, energy, healthcare, and staples. The sectors that have the worst performance in stagflation moving into recessionary environments are technology and consumer discretionary. So what we're recommending to clients is to start that value rotation. So here you can see exactly what the year-to-date returns have been. Energy has been a star performer. Utilities, staples, materials is an inflation hedge, and healthcare. So effectively, these are the sectors that have been outperforming year-to-date. In fixed income has had the worst month in many, many years, down, according to Bloomberg, about 5% in the month of April. And that's been a very ugly time. Of course, this comes on the back of an inverted yield curve and a market that is discounting a more aggressive Fed. We do see some potential within the fixed income space, specifically within quasi-sovereigns that are commodity exporters and have some energy components. So we do like those names, specifically in Colombia and Brazil, which are facing some very important elections this year, but they are names and countries in which we see a very potent combination of an undervalued currency and juicy yields on the bonds. To round out our investment asset allocation recommendation, we like alternatives. Alternatives is a broad umbrella, but within alternatives, you have different instruments that have lesser correlations with the broader public markets. And we think that makes sense. So to have a position in gold makes sense. To have a position in general commodities makes sense. Even incorporating Bitcoin into the alternative section of a portfolio to us makes sense. And you can see here in the presentation, we have found that there's a negative correlation with the US dollar. So that's something to be on the watch. So with that, I will close to keep my comments short, and I look forward to your questions.
Thank you very much. A chock full of information from Kathryn Rooney Vera. Well, we have to get the conversation going now because you gave us a lot of meat to chew on, Kathryn Vera. We have a central banker with us, the Senior Deputy Governor of the Bank of Jamaica, Dr. Wayne Robinson, and we have the CEO of one of the most powerful private sector groups in the country. And Kathryn, first question for you. You mentioned Colombia, yes? Which other countries do you see as having possibly facing the biggest challenge in terms of their outlook and the best prospects, given the headwinds that are gathering in the world's largest economy, the United States?
Well, those countries there are always winners and losers. And in geopolitical tensions, as we've seen and continue to experience with Russia and Ukraine, in theory, there is market share to be picked up by some Latin American exporters, specifically of those products that Russia and Ukraine have not just, decreased their exportation of. Wheat, corn, and soy come off the top of my head. So in theory, Brazil, Argentina, Uruguay, these are countries, and I'll throw Colombia in there too because oil prices have gone up so much, Mexico as well. These are countries that stand to benefit. Now, whether or not they capitalize on that ability to gain market share, that's up to them. But that's why I specifically like quasi-sovereign, some corporates within those spaces. Now, the countries that are losers in terms of the geopolitical sphere are those that have to import a lot of those commodities that don't produce them themselves, because those are the countries that are going to see very painful inflation on basic staples in a person's day-to-day life. We're talking gas and food. So that's.
And Kathryn, that sounds unfortunately like Jamaica.
I know it. I did. I know it, Mr. Hughes, and I think it's unfortunate, but that is the situation, and in inflation results. The good news for Jamaica, I will say, is that tourism has picked up. I don't know if you've felt it yet, but yes. Americans are back on the planes. We're back taking our vacations. We're feeling good now that we're all back vaccinated. So that pillar of the Jamaican economy, I would hope, is already feeling the effects of that boost in confidence with regard to tourism.
Let me bring in the president and CEO of Sagicor at this moment. You heard that from Kathryn. How do you see the inflation headwinds, given what we have been experiencing, what our central bank has been trying to do? How do you see the next near-term few months in terms of impacts here?
Well, Cliff, it's clear that the headwinds are real, and the biggest concern is inflation for everyone. Mm-hmm. Inflation eats away at the fixed income earners, the pensioners, etc. I think I am confident, extremely confident, for a number of reasons in Jamaica's resilience and ability to overcome these headwinds in the short term. One is that we've been there before. We're an extremely resilient country. Two is that the institutions that guide the economy have a tremendous level of confidence now, more than ever before. And we can point to the central bank, its resources, its people, its ability to be data-driven, etc. We can point to successive administrations, political administrations, exhibiting fiscal responsibility, yet navigating COVID, for example, providing payments and welfare to those most affected, the poor, the old, etc. And I would also say two other things. A very strong financial sector, The last few years of fiscal responsibility have kept our debt to GDP within manageable levels, still have work to do. But that gives us a lot more strength to withstand some of the shocks we're seeing. And a strong financial sector. We have exited COVID with very strong capital adequacy, good profits, continuing to serve our clients and so on. And we have a general entrepreneurial and business class that is, I think, extremely prepared to face the headwinds we face. So I'm confident.
Yeah. Dr. Robinson, as a central banker in our midst, you saw what your colleagues up north did today, but you have been taking steps several weeks before now, yes? Given the developments today, how do you interpret those impacting what we have been trying to do to tame the monster of inflation?
Thanks, Cliff. Let me first thank Sagicor for this opportunity. We at the Central Bank, we really appreciate such an opportunity to really share with the public. From August, the Central Bank started to signal to the country that we are going into a rough period where inflation is concerned, and we needed to act. And we started the process of tightening monetary policy in late September, early October. Now, we had to take this approach. We had to take a very proactive approach for a number of reasons. One, we knew that there is a risk, and there still is a risk, that the inflation dynamics could get out of control, that it could feed on itself. This typically happens when you have poor policy with an inflation shock. So we had to start acting early. The other thing as well, we knew that it takes time for monetary policy to impact the economy. And so we're always having to look ahead, at least 1 to 2 years down the road. Mm-hmm. The other reason why we were started to act early as well is that even though way back in August, September, the big central banks, they didn't start to move as yet. We expected that certainly by early this year, the big central banks would start to move. And we already saw what the Fed did today. So we expected global financial conditions to tighten. So we had to position ourselves and position monetary policy to face this scenario. And so we have started on a very gradual, but we have picked up the pace a bit, because we realized that we had to achieve a couple of things. The shock, as Kathryn would have explained, is largely external. So one of the things we had to do was to ensure that, because we import all these goods, we had to ensure that the exchange rate itself doesn't add to the inflationary pressures. The other thing we had to ensure, and we had to do this very carefully and very delicately, we had to ensure that we keep demand in the economy in check, such that it allows for prices, that it tempers the rate at which prices will move. So we did a couple of things. We started to raise our interest rates. We have done 400 basis points so far. The other thing, importantly, that we have been doing is that we have been very proactive in the foreign exchange market. And you'll observe that certainly since January, the exchange rate has been pretty stable. We have also been trying to contain the expansion of domestic Jamaican dollar liquidity within the banking system. This helps take some of the pressures of the foreign exchange market. So we have had a three-pronged approach. It's a very delicate balancing act, because we do not want to upset in a significant way the recovery in the economy, although we know it will affect demand. So we have a very difficult balancing act to do.
Well, I want to bring Kathryn back in, yes? Kathryn, given the turmoil we're facing, what are you seeing regarding green financing being impacted by the current global events?
Well, it's certainly taking I would say, a backdoor to conventional oil. I think that Germany and France realized that they made a big mistake when they decided to focus on green and start to really become vulnerable and bring what, if I'm not mistaken, 40% of their oil necessities come from Russia. So they increased their vulnerability to Russia. And really, that's been a sore spot for Germany and France especially, but Europe as a whole. My suspicion is that they're going to turn on the taps. I know here in the United States, that is definitely going to be the case. The U.S. has decreased its production recently. It's likely going to ramp that up to maintain energy independence so that the United States does not have to knock on the door of Venezuela, which is something that we effectively did during the peak of the strife in oil prices. But my suspicion is that Europe is going to have to become more energy, not independent, but at least increase their import of those energy needs from places other than Russia. So I think that globalization in that sense is going to rise in terms of NATO, new members to NATO, and in terms of the commitment to seek alternate needs or alternate sources if they can't be energy independent. But I know that hydraulic fracking and even nuclear energy are currently being seriously discussed both on the European continent and in the United States.
Okay. Christopher Zaka, Sagicor, how are you responding where interest rates are concerned in this new environment? How are you responding?
Well, it's more than just interest rates. We're exiting 2.5 years of COVID. It's a new paradigm, a new normal for all businesses. In Sagicor, as I think many of my colleagues in business, we've realized that we have to be, as a leadership, as management, more nimble. We have to rely on technology more. We have to keep our team engaged because there will always be a hybrid situation where some come to the office, some work from home. That's forever in our view. How do you keep them engaged? How do you keep people motivated? How do you build social capital in that environment? So a management that is plugged into its team, that is reliant on technology, and finally is nimble and agile in its decision making. I think that's our approach, and I think a lot of other colleagues of mine are taking a similar approach. In terms of interest rates specifically, Cliff, we have a very diverse business in Sagicor. We cover every aspect of financial services, and as a result, we have parts of our business that does a little better with higher interest rates, and we have parts that may suffer some damage because of higher interest rates. Overall, we have a treasury team that's managing our various balance sheets very appropriately and ensuring that our mix of assets matches our liabilities in a way that we insulate ourselves from some of the possible shocks. I think we have a great team. We're on it every day, and I think we'll be fine.
Your investors are online, yes? What investment strategies you think they should be taking on now, seriously contemplating as strategies, given the uncertainties?
Well, I mean, the expert Kathryn spoke about some of the sectors and various, and
yes,
that applies to Jamaica too, in my view. But rather than give specific advice, my advice is very simple. Go and find yourself a professional investment advisor. Don't rely on your own. I believe Sagicor has the best, but if you don't want to use Sagicor, go and find another advisor somewhere. We have hundreds and hundreds of highly qualified advisors and experienced ones too. Secondly, diversify. This is not a time to put your eggs in one basket. I mean, that's kind of traditional investment advice, but in my view, you heard Kathryn speak about some alternatives. You know, look around. Real estate is a possibility. You heard her speak about commodities, etc. You know, there are options. We're an open economy. We're lucky to be able to access a wide range of assets in our investment portfolio. And finally, things are tough. Prices going up. As hard as it is, try and save, try and invest whatever you can. That is my advice.
And to the central banker, Dr. Robinson, where do you see areas of resilience or bright spots and prospects for growth in 22-23?
Right, well, Cliff, I'll start where Kathryn ended her presentation on tourism. Yes, Kathryn, I mean, since last year, our tourism sector have been coming back with the reopening of the economy and the reopening of travel. And we expect that to continue and pick up this year. Currently, visitor arrivals are about 73% of where they were in pre-COVID levels. And our view is that all things being equal, if we don't have any more shocks, we think that certainly by early next year, the tourism industry should be, fully recovered by early next year. I mean, certainly the representative from the sector is even more bullish than we are. Looking at what they're seeing in the forward booking so far, I think there's a lot of optimism there. Now, of course, with tourism coming back, we expect to see some spillover effects on the transportation sector, some effects, positive effects as well on agriculture. There are other sectors that we have to look at. The construction sector was quite resilient during COVID, and we expect that to continue, both in terms of public construction and in the private real estate market as well. With the reopening of the economy, other services will bounce back, entertainment services, for example. BPO sector, that had started to recover late during COVID, and we expect the BPO sector will also continue to grow. This year, we also expect to see a big bounce from the mining sector. Last year, the Jamaica major alumina plant actually shut down, and we expect that certainly by the end of June, that plant will reopen. So we see there are a lot of positives. I mean, when you look at all the data, what is coming out of Statin, it's clear that the economy is on a recovery path. Now, there are a lot of uncertainty. I mean, the outlook is very foggy. We have spoken about the headwinds. So there are downside risks, but we certainly expect the recovery to continue this year. We're probably looking about growth somewhere between 2 to 4% this fiscal year.
Okay.
But there are downside risks.
Well, let me invite our viewers, yes, wherever you are in the world, you are invited to put your questions for our panel, Kathryn, Christopher Zaka, Dr. Wayne Robinson, yes. You can share your question on whatever platform you're joining us via Zoom and social media, okay? So we look forward to those questions. But Kathryn, before I let you go, you did say that where recession is concerned, so long as you have 2 people, right, available for every 1 job, you don't see that really being a real prospect, yes? How confident are you about that?
It's hard to imagine, Mr. Hughes, a recession occurring when you have 2 job openings for every 1 person that's unemployed. So that's going to be one of the measures that I'm looking at in terms of the breadth of leading and indicators that I consider that I'm going to be watching for. So recession this year, very unlikely, I think. Mm-hmm. But recession is an inevitability in that, and Dr. Robinson can explain this better than I can, it's part of the economic cycle. So if one agrees with the economic thesis that we have hit the peak in this economic cycle, and we are effectively in the descending part of the economic cycle, then recession is the next step. Now, it can be 6 months, 12 months, 18 months, 24 months, difficult to measure. But while the labor market remains that hot, it just tells me that business is good. And if business is good and there's 2 jobs available for every 1 person that's unemployed, then gosh, hopefully what we see happen is that the labor force participation rate increases because people start to look for those jobs. I really don't know the answers to why people aren't looking for jobs, but they are not yet. So what we want to see is the labor force participation rate increase, which would mean that the unemployment rate goes higher because there's more people counted as unemployed because they're simply looking for work. So those are the things that would be positive, to see the unemployment rate go higher just because people are starting to look for work. So recession is something that's going to happen at some point, and that's one of the indicators that I'm looking at.
And what of the Russian war being waged on Ukraine? There are indications that that war is not about to end anytime soon. Only today, the president of the European Commission increasing sanctions, saying the EU, before the end of the year, will be banning Russian oil imports.
That's a huge problem. Look, if Europe really does import 40% of its natural gas needs from Russia and 30% of its oil needs from Russia, closing off that spigot will throw Europe into recession. Why? Because you have factories that close down. Consumers are paying through the roof for oil prices, which means that they buy less things. They renovate their house less. They travel to Jamaica on vacation less. It's very complicated if there are wholesale sanctions on the broad energy spectrum of Russian natural gas or oil, or if Russia decides that it's going to increase tensions to put itself in a better bargaining position, a better negotiating position. That could still happen. So Russia could turn off the pipeline that takes gas from Russia to Europe, throw Europe in recession, and say, all right, guys, I'm in a better negotiating position now, so I'll be taking half of Ukraine. And I'll be assuming that as part of Russia. These are risks that could still play out. As you said, and I agree, Mr. Hughes, it's not something that looks like it's going to end anytime soon, unfortunately, which means additionally that oil prices are going to continue to see upside pressure. The good news here, and especially for oil importers such as Jamaica and a lot of Caribbean islands, is that a lot of energy or oil production is going to come on through the pipelines here in the United States. So we're turning on the spigots, we're reopening, we're trying to reduce regulation, we're trying to increase production to be able to match demand so that oil prices don't continue to move so aggressively higher.
Mm-hmm. Thank you, Kathryn. Well, we have a question from social media relating to the Russia-Ukraine war and the impact on the supply of oil across the world, and what does that mean for a heavily dependent country like Jamaica on oil imports. And this question is seeking to ask, and I'm going to put it to Dr. Robinson. I think the person is seeking to ask, how will this impact our debt, if it does, because we have removed the oil hedge? I don't think it will impact the debt, but certainly, what does it mean for our ability to finance oil imports if the price of oil continues to go?
Okay, let me deal with the question about the debt first.
Yes.
I mean, you're correct. I mean, it will not have an impact on the government's debt. The government doesn't have a significant financing need. And in fact, we do expect the government's debt to continue to decline. It declined last year to about 96, and we expect it to go down to about 87 this year.
That's 87% of gross domestic product,
GDP.
right?
So we're not expecting to see an impact on debt. In terms of the country's ability, though, to finance the import of oil, first of all, that depends on our foreign exchange earning capacity. And of course, with tourism coming back, with other exports growing, with mining exports coming back, with continued remittance inflows, and also importantly, with the strong reserves that the Bank of Jamaica have, we will be able to continue to finance our imports of oil. But fundamentally, though, this crisis is signaling the need to really structurally transform the economy, to move away our dependence from fossil fuel and to diversify our energy mix. I mean, we have made some progress, a lot of progress, and I think Chris can speak a lot to that because he was behind it, in that we have diversified a lot now into LNG, and the government has a much more ambitious plan to even move further away from fossil fuel. The Prime Minister spoke to that in his budget presentation. That is actually what we need to focus on now, that transformation, that diversification.
Okay. Thank you, Dr. Robbins. Well, what does it mean, for you when you hear about a stockbroker? What does it mean to be a stockbroker? We're going to take a look at David's stock brokerage journey, okay? And we will provide responses to your questions after the break. But keep the questions coming on social media, okay?
Hello, my name is David Rose. I'm a 23-year-old final year major at the University of the West Indies in the field of chemistry. I'm a proud Sagicor Investments client and I'm an investor on the local market. I became a Sagicor Investments client because it was the most cost-effective broker and it allowed me to start my account with just $9,000 as a summer intern in my first job. The reason why it matters to invest now, or just in general, is because your money works out better in the long term. I started with $9,000 and in less than 2 months, I got my first dividend check from Sagicor Jamaica, which was $500. It's so comfortable seeing my money actually work for me. I had to do summer school and it was that time of investing in the markets when things were relatively up, which allowed me to cover that summer school tuition at university. My investment style is focused more on, risk management and just, seeing how it can be fun, because it's always fun to earn money, and the reality is, who doesn't want to earn money without having to step out of their house? So when I first went to Sagicor Investments, I met up with my advisor. At the time, she was relatively surprised as, to my age at the time, I was just 18, and to the trust of the company I wanted to invest in. She was like, why this company? And I'm like, it's a new banking arm and it's such a great company for operations. And at the time I didn't know about the company's full depth, but it was a wise investment then and still is now. So my experience as a Sagicor investment client has been quite rewarding and quite fulfilling. So apart from just the low fees and low cost, there's the option of learning about the diversified products such as unit trusts and other opportunities. And there's just the rewarding experience I'm doing that there's someone I can contact to find out what else is there for me to look at, because investing here is quite a journey and it's been something that I'm going to continue for many years to come.
David Rose, young stockbroker, and you should see the faces of the Sagicor people in here, proud parents. Well, thank you so much for staying with us. You're watching the third staging of the Money Talks series. In today's discussion, Sagicor Investments explores geopolitical events and, of course, investments opportunities. We're going to ask a few more questions. As I said, keep the questions coming on your social media platform. We have one for Deputy Governor Robinson. Minister Clark stated that the introduction of the $2,000 banknote will offer the consumer and corner shop greater flexibility. Please expand on how this will benefit the consumer. Why were our banknotes upgraded?
Okay, all right, thanks for that question, Cliff. Over time, banknotes, they were. Over time, the technology underlying the banknotes improve. They get better, both in terms of the security features, in terms of their durability. And when we look at the current family of banknotes and looking ahead, we recognize that there was a need, given those factors that I mentioned above, before, there was a need to refresh our banknotes. In addition, we also look at the sort of transaction turnover of these banknotes. And of course, inflation affects that as well. Inflation determines that. And when we look at each of the various denominations and the relative demand for them, it was clear that we needed something a little bit below the 5,000, above the 2,000. I mean, as any Jamaicans, you know, there are certain places you can't go with a $5,000 bill, you know, and certainly for, you know, the average person. And so we therefore needed to be able to facilitate the average consumers in terms of their transaction, in terms of being able to conduct transaction in the most convenient way. So that is predominantly why we had to reload the notes. One, to ensure that we have a structure that facilitates easy transactions across all income groups. And two, we have a set of notes that meets the best standards, that is on the cutting edge in terms of security and durability.
Thank you. Kathryn Rooney Vera, here's one for you. What is the likely impact of the fifth wave of the COVID pandemic on emerging markets, especially given the reopening of countries like Jamaica?
Well, if the fifth wave, as we saw in China, happens to the same extent in Latin America, and Latin America responds by shutting down and being as aggressive as China has been, then we're talking about a double dip recession. My suspicion, however, is that Latin America is unlikely to follow the same route as the zero tolerance for COVID policy that China currently is exercising, because that, in my view, is very unrealistic. With the increasing vaccination rates and the infinite morphing and variants of this disease, and in addition, the herd immunity that we're seeing, my suspicion is that Latin America will be able to come through this and continue to recover. I take my hat off to the Central Bank of Jamaica, the Central Bank of Latin America. A lot of Latin American central banks have done the homework and have done the rate hikes that were necessary over the past year to curb inflation. Such a different story than that we've seen in the United States, where the Federal Reserve is very behind the curve. So to answer the question, I think the worst that we're going to see with this fifth wave, we're already seeing, and that's in China. And my biggest concern with the aggressive lockdowns that the authorities in China are currently engaging in is the global impact that those lockdowns could have again on the supply chain across the world. So that, I think, is the biggest concern for Latin America, the US, everyone in the world, because truly China is the factory for the world. And if that factory even partially closes down for any significant amount of time, then it will cause price increases across a myriad of goods.
Mm-hmm. Thank you very much, Kathryn. Chris Zaka, how do you see the new normal post-COVID environment impacting business and corporate Jamaica?
Well, as I said, we have to change our management style. Mm-hmm. We have to recognize the different types of consumers that our clients that we serve. The younger people really have very little interest of walking into a bank hall, for example. And this has been accelerated by COVID. People want to be able to live a more balanced work and home life. That, you know, going through that terrible situation we have faced. And I think we just have to be, as I said, we have to be aware of the social capital we build in our companies, how we treat our clients and our customers, and also be very agile when it comes to technology and technological improvements. And just stay connected to the people. You know, we could say technology is all now, but without the people, it's nothing. And I think that's important.
Mm-hmm. For you, Dr. Robinson, the central bank digital currency, Yes, what feedback are you getting? How is that going? How is it being received?
Well, you know, Cliff, the feedback has been very positive, very good. I mean, NCB has taken the lead, and they have launched their wallet with central bank digital currency. The pilot that we did in December, but ended in December, was very, very successful. And NCB is really pressing ahead. They have over 100,000 customers who have actually logged on for CBDC. And in fact, over 83,000 persons have actually taken up the minister's offer. So we're seeing a lot of interest. I mean, persons really want to know about the product, how the product will help them, what advantages the product has. And we know that, for one, it will provide consumers with a lot more convenience. It will, of course, deal with the problem of the cost and the inconvenience of handling cash. And we think that's very important. So we also think that it will provide a major catalyst to financial inclusion, getting more people into the banking system. It will also provide a lot of big catalysts to the whole digital transformation of the economy, getting more people into this digital sphere. So this is something that we really look forward to, and we hope that other banks will join us very soon.
Well, let me put it to the CEO and president from Sagicor. Sagicor, you run Sagicor back, well, you run the group, including the bank, yes? Where are you with the central bank digital currency push?
Well, the first thing I'm trying to figure out is we're the senior deputy governor, that bank he mentioned, who are they? No, we agree with the reasons why we need a CBDC, and we are in the process of developing our own digital wallet. We wanted to make it a broad, encompassing digital wallet which can do a number of things and has variability and pluggability. So, for example, one day we'll sell all of our products on it, for example, and CBDC will be a part of that wallet.
Mm-hmm. And any timelines you have?
No, I'm not prepared to give those, but we have our innovation team and our advisors. As a matter of fact, they will be heading to New York shortly to work with one of our big partners in the financial sector up there to start to flesh out the timelines, etc.
Good. Okay. Central Banker Robinson, here's another one for you. Yes? How do you see remittances evolving out of the pandemic?
Okay. Well, you know, Cliff, I mean, remittances perform very strongly, even above our expectations during the pandemic. I mean, we do know that in times of distress, the diaspora comes to the rescue and support of Jamaicans. But we also believe that because there is a restriction on travel, the members of the diaspora channel those remittances through the financial system. So we were seeing flows that were probably coming in when persons were able to, well, we call them in-pocket flows. They were probably coming in before the travel restrictions. So now we're just picking them up in the financial, through the formal financial channels. So we saw growth of about up to 30%. Now, coming out of the pandemic, of course, we expect a normalization in these flows. And certainly we have been seeing a slowing. I mean, in January, February, the growth slowed to about 8%. In March, we saw a little decline in terms of the inflows. So it is not surprising that we would see some tapering in these flows. But notwithstanding that, though, we still expect the flows to remain pretty high. We expect remittances to remain about 17-18% of GDP. Prior to the pandemic, it was about 15-16% of GDP. So even though we're expecting a tapering, flows will still remain high, certainly in the very near future.
Mm-hmm.
And I didn't hear him say that with Sagicor's entry into that market.
Well, tell me about Sagicor's entry into the remittance business.
Well, as most people know, we acquired Alliance Financial, which had been shut down for a number of reasons. We're back up. We're back up since the 4th of April. The Bank of Jamaica has been very, very proactive and facilitative to allow us to quickly re-enter that market. And we're going to grow that network, and it will only mean positive things for the industry in terms of remittances, in terms of foreign exchange. We're going to apply all of our marketing skills and distribution skills. And it'll mean a very positive thing for us and for the economy.
Mm-hmm. All right, let's go back to our social media audience. Question from social media. Peter on Sage says, when do you see the Fed being forced to start cutting rates? Well, Peter, they only raised them today. Well, let me put that to Kathryn.
That's a long day in coming, I think. They're going to be hiking rates for the foreseeable future because inflation is unlikely to come back down to the 2% target. Now, that's an average target, but it's unlikely to come back down to 2% over the course of the next year and a half at least. So expect rate hikes, not cuts, for all of this year and all of next year before we even think about cutting rates. Now, cutting rates, it's a good question if we go into recession. If we go into recession, the Fed does need to have that cushion. Right now, if something happened, as we saw happen with Russia and Ukraine, really the Fed there's no cushion because the Fed was already at zero rate. So you want to get off that zero rate bound. And want to take rates higher, we'll probably, get to 3.5%, maybe even 4% before the Fed stops hiking. That's my view. And then if in fact the recession does occur at that point in a year and a half, 2 years perhaps from now, that's very hard to forecast. But at that point, the Fed would think about cutting rates, but not before we get to that, at least towards the 2% target. Right now, inflation just is moving in the wrong direction.
Yeah. Dr. Robinson, here's another question from Keith Ferron on Zoom, and I'm putting it to you. He says, what is Jamaica doing to stem the excessive reliance on foreign imports? And equally, what are we doing to drive exports? What about agricultural exports? I've heard this question asked for so many years.
All right, thanks, Keith. I mean, I probably could take the rest of the evening to go through. But what we really need is a very diversified and competitive economy. That is an economy that can produce a number of different goods at a competitive rate that it can sell competitively both locally and abroad. To do that, there are a couple of things we have to do. Well, first of all, we had to get the macro fundamentals of the economy correct. And, Jamaica over the years, our growth prospects have really been blighted by severe macroeconomic imbalances. And over the last 5 or more years, we've spent a lot of time trying to correct those. And I can say right now we have a pretty sound macro fundamentals. So now we need to go beyond that. We need to raise the level of productivity in the economy. Factor productivity, labor productivity, the productivity of capital. How do you do that? Well, one, you have to improve your labor force, the quality of your labor force. So this is where education and training is concerned. We have to open up ourselves to be able to absorb new technology. So this is where transitioning the economy into a more digital economy becomes very, very important. Importantly, we have to lower our energy costs. We have about the 4th highest energy costs in the world. So in order for us to be competitive, we have to bring that down. So this is where the diversification of the economy is concerned. The diversification of our energy mix is concerned. So there are quite a number of things that we have to tackle at the same time.
Well, interesting you mentioned energy and our parlous place in terms of energy. Chris Townsend on Instagram says, will we be focusing on renewable energy?
Well, the Prime Minister answered that in his budget presentation, and that was clearly one of his priorities. I mean, he has actually set an even more ambitious target of getting us to 50% down the road. So we expect that the government will move along those lines.
Mm-hmm. All right. Henika Watkis Porter on Zoom. says, given the global climate, with the backdrop of the tail end of the pandemic and now the Russian-Ukrainian war, what can we expect of the local stock market? Chris, you want to take that?
I don't know if I'm qualified to take that, but so the stock market took a big hit in 2020 at the start of the pandemic. A big hit. It had been riding very high for a number of years, and rightfully so, because the fundamentals in the economy and the earnings of the various listed entities were reflected in much higher stock prices. I expect there'll be a gradual recovery. I think you heard the presenter, Kathryn, speak about fixed income taking a big hit this month. So investors will turn to equities, in my view, as long as the fundamentals of the economy remain, that the various institutions that manage our economy don't let it get out of control, which, as I said, I'm extremely confident in their ability to control the economy. As long as things remain stable in terms of just basic macro fundamentals, I think earnings will continue to be strong. We heard today one of our listed entities buying a major company in Trinidad and Tobago. So our companies in Jamaica, we are expanding into Latin America, we're expanding further into Cayman, Sagicor, Jamaica, and we're now looking outwards too. I think earnings will continue to be strong, and I think the stock market is a good place to look at. But as you heard Kathryn say, pick your stocks. Look at what companies are doing well, which ones are inflation proof, etc., and be judicious and use an advisor.
How do you define an inflation-proof company?
Well, Kathryn, why you don't tell us what that is?
Kathryn?
Well, there's companies that can pass along the costs easier. So those are the inflation hedges. There's inflation, less inflation sensitive in the sense that if they can pass along the cost. So staples, for example, materials, industrials, these are real estate. I think one of the panelists mentioned real estate. These are areas that hold their value or can pass along those costs, and people will continue to consume them. For example, discretionary. You don't have to take that vacation to Jamaica. It would be wonderful. We would love to do it, but that's discretionary spending. Buying a Louis Vuitton bag, that's discretionary spending. So those are places where when push comes to shove and prices go higher, you want to be in the staples, you want to be in utilities, you want to be buying stuff like toothpaste and beer companies, because people still drink beer during recessions, people still brush their teeth every day. So those are the places you want to be. But in my research, the sectors in the S&P that are the best inflation hedges, we're not talking about stagflation or recession, are materials, industrials, energy, and I would say banks do pretty well too. But right now, we're not just talking about reflation or inflation. We're talking about stagflation, which is that nasty combination of slowing economic growth and very sticky inflation. And under that scenario, you want to be in energy, utilities, staples, and healthcare. Those are the best bets in terms of high inflation and slowing economic growth.
And stay tuned. Thank you very much, Kathryn. But stay tuned, because right here this evening, we have a special presentation from Jody and Aries dealing with that very question. Yes, which stocks you are likely to probably take a closer look at. Okay, that's coming up in a few. Final question now from social media. Who should I direct this to? The central banker. How safe is a digital wallet?
Very safe, Cliff. Very safe. In fact, we require...
Scammer-proof?
Scammer-proof. We require that these digital products meet the highest level of security. We also require that the systems be subject to independent or third-party security tests as well. Bank of Jamaica's own system is based on a multi-layered encryption technology. And we test this continuously. We get external companies to actually test the security.
And when you say stress test, they try to hack into it.
Exactly.
And it has stood up.
It has stood up.
Oh.
It has stood up. So that's something that we are very keen on. I mean, we know the environment that we're in. We know that cyber risk is very elevated now. So that is something that we pay very keen attention to.
Okay. Here's another quick one for you, Dr. Robinson. How would you characterize the strength of our financial system, its ability to absorb further shocks?
Well, the financial system has shown itself to be very resilient to COVID. The financial system remains very strong, very sound. It has more than sufficient levels of capital. The levels of capital within this deposit-taking institution is above the prudential standards. It's above international standards. And moreover, when we assess the balance sheet of the financial institutions and we subject them to different stresses, when we look at their balance sheet under very extreme scenarios, including sharp rises in interest rates, over and over they continue to show themselves to be very robust to shocks.
Good. Thank you. Well, thanks so much for your social media questions. It is time now to test your knowledge and win one of 4 giveaways. Okay? 4 giveaways. The first 4 persons to respond with a correct answer will receive a gift from or to use at Blink Sky Jamaica Limited. Here's question number 1. Name the Sagicor Investments online platform that facilitates the electronic submission of application forms for initial public offers, IPOs, additional public offers, APOs, or rights issues. Question 2. What is the name of Jamaica's top performing investment funds in 2021? The winner will be announced towards the end of the show. And listen out for the answers. Did you know that Sagicor Investments facilitates the electronic submission of application forms for IPOs, APOs, or rights issues? Now, here's how you can make your submission. Wow, thank you so much for staying with us. Yes? Remember to participate in this evening's discussion by using the hashtags Money Talks, Sagicor Investments, Investor Briefing, right? And here's a treat for you. We have with us Sagicor's Research and Strategy Analyst with Sagicor Investments, Jodianne Aries. Today, Jodianne will explain how you can use the information learned to expand your investment portfolio, your wealth creation portfolio. Right? Jodianne.
So we have looked at what the impact is for global on the global market. Kathryn would have shared some recommendations for the international market. So I'm here. What about the local equity market? So at the start of 2022, the research analysts at Sagicor Investments did some robust analysis. We looked at best case scenarios, we looked at worst case scenarios, and we developed an outlook for 2022. Since then, we have seen where inflation has been continuing to rise, where notice prices are rising, and as such, this has led to a downward revision in growth expectations. However, our recommendations have been standing and they remain, and so we continue to put to our investors that in terms of equities, you should stick to value over growth stocks. When it is that you're looking at treasuries, you should stick to shorter maturities. And to echo what it is that Kathryn had said, we are also recommending that you take a defensive stand and that you stick or you lean towards commodities and alternatives. Zoning into the local market in terms of the macro for the local, we are expecting growth for 2022, and this is largely based on the fact that we are seeing quite a bit of reopening. We're expecting better in terms of tourism performance, and so this is fueling growth expectations for 2022. However, there are still challenges on the global market that we can't run away from, and so those will have an impact, particularly inflation. We expect that this is going to remain elevated for 2022. We'd have mentioned in terms of how it is that the conflict is going to have some impact, particularly on us because we are price takers, and so we're going to be seeing how that plays out in this year. In such a climate, what is important is policy response. And thus far, we have seen where the central bank has raised policy rates by about 400 basis points, and our expectation is that come this month, they'll also continue to do another hike. And so we look forward to see how that can continue to help in terms of alleviating price pressures. We also see where the government has been reducing measures associated with COVID-19, and that has bolstered demand, and we expect that to continue throughout 2022. Now we're drilling down. So we started with global, we did a little bit of local in terms of the macro environment, but what does this mean for your portfolio? Let us move to some of the fun stuff. So the junior market companies have been doing well, and so we saw where last year junior market was star performer, and it continues this year to shine very bright. And as of April, at the end of April, for the first 4 months of 2022, we're seeing where the junior market index is up approximately 30%. And right across the markets, we're seeing improvement in terms of margins are improving. We're seeing improvement as well in terms of net profit. However, we're still seeing some of that impact in terms of what's happening globally, and this has resulted in varied risk across the sectors. So our sector picks for the local market, we're saying that you should overweight in hotel and tourism. And we also like manufacturing, distribution, and retail companies because these companies are able to absorb a little bit better in terms of the inflation. So they're able to pass on that inflation to consumers and not be as impacted as other companies. In terms of financial, they have been taking a hit. At the start of COVID, we'd have seen where equity prices fell and there were higher expectations for credit losses, and we saw those prices for financials fall. Now we're in a rising interest rate environment, and we're seeing where bond prices are going down, and the balance sheet of these financial companies are going to take another hit. And so in that space, we're not as aggressive. Specifically for the overweight stocks. So when we say overweight, our recommendations in this area are stocks that you should take a position in. If you don't have it, you should get it. If you have it, you can take a little bit more of it. So we're looking at Grace Kennedy, who is in food space, and we think that is a consumer staple and should work well. We're anticipating to see continued growth in this era. So when we look at the next 5 years for Grace Kennedy, we're seeing that it's going to grow at a faster pace than the previous 5 years. And so we think that is good. There's a possible upside for you of about 29% based on our estimates. We're also looking at Jamaica Brawlers that has been doing well in the US market segment, and we expect that this is going to continue to provide growth in terms of revenue and profit for the company. Another, I touch on the junior market. We have AMG Packaging, Paper and Packaging Company, and they have been doing well. So for the first 6 months of their financial year, so the first 6 months to February 2022, revenues have been up by 44%, and net profit has been up by 150%. And we expect that this is going to continue in the second half of the financial year as we see that sort of build up and improvement in terms of economic activity. Within the financial space, we have two companies that we are recommending. These are Panjam and JMMB Group Limited, and these companies are trading below multiples relative to their industry peers, and so there's a good time to buy in and receive some upside potential. Now looking at some market weight stocks, so these are trading close to where it is that we think is a fair value for them, and they're aligned with our recommendations of sticking with value over growth. And so our estimates show that Wesinco, NCB Financial Group, and a Guardian Holdings Group are trading at around their fair price. So if you have it in your portfolio, you can continue to hold it there. You don't necessarily need to buy anymore. In terms of those that we are considering to be underweight, so these are companies that if you have them in your portfolio, it's about time that you say bye-bye. So we're looking at Wigton Wind Farm as one of those companies. So that company would have seen quite a bit of upward movement in price in recent times on the basis that they would have announced an acquisition within the electronic vehicle space. And so that brings some good news. And so, we saw that movement in terms of stock price. However, one of the headwinds for Wigton Wind Farm is that they are going to have to replace turbines, and this is going to come at a significant cost. All right. Similarly, for Mailpack, it's operating in a competitive space, and it's likely that they could reduce market share. And so this is one of the things that would play into them not being as profitable next year as they were prior to, and we're recommending that you take a little bit of an exit at this point in time. Now, everybody loves a good IPO, and there have been some that have been recently added to our markets in the past 9 months. And I just want to provide from our standpoint an updated view on these companies. So, as I mentioned, junior market has been doing well, up 30% since the start of the year, and some of this has been due to new listings in that area. And so we are recommending that if it is that you haven't bought into Spurtree as yet, then you can consider getting some exposure there. If it is that you have exposure to the Edifocal and the Fiberglass and Fesco, that you continue to hold those positions. In terms of main markets, we're seeing where Massey is now trading at a fair price, and so our estimate is around where it is currently trading at around 98, and we think that is a fair price for the company, and so we're recommending that if it is that you have it in your portfolio, you can continue to hold it. Now, this is just a snippet as usual. I can't give you everything in just a little short time, so as our CEO said, talk with a Sagicor advisor. I recommend that you seek out a Sagicor advisor and get some more details on what it is that you can do to boost your local portfolio.
Very, very good. Jody and Aries. Thank you, Jody, and a whole lot of good information you can make use of. I heard her mention some stocks. I'm going to go call my banker tomorrow, my broker tomorrow. Anyway, here's another question from Zoom. Last one for the evening. Loyal Haylett. Is Sagicor planning to get into NFTs? Christopher Zaka, first of all, tell us what is NFTs, yes? And are you planning to get into NFTs?
So an NFT is a non-fungible token, which is a digital asset which represents a unique, let's say, thing. It could be a song, it could be a painting, it could be a drawing.
It could be a meme.
It could be a meme, it could be a piece, but I go further, it could be a piece of real estate.
Oh.
And it could be a fraction of an asset. So we could end up one day with tokenizing this building, the Pegasus, and having it in a fund and buying little pieces which are unique.
Oh.
Are we going to get into it? We are we had a leadership meeting. Sean was there, Tara was there on Monday, and I charged my team for each of them to take a portion of their week or their day and study blockchain, study crypto, study NFTs, study DeFi, and be prepared, and let us look at how we can enter this space and what strategies we can employ. So the answer is yes. How is still up in the air.
Yes. Thank you very much. Well, having thanked Jody Ann, we are coming towards the end, and if you are interested in investing, call 888 Sagicor. That's 888 Sagicor to speak with one of their wealth advisors. And of course, it is time to announce the winners of the giveaway questions. Yes? The first question, do we have all winners? Yes? The first question was, name the Sagicor Investments online platform that facilitates, yes, that facilitates the electronic submission of application forms for initial public offers, additional public offers, or rights issues. The answer is E-Invest, okay? E-Invest. And what is the name of Jamaica's top performing investment funds in 2021? You guessed it, you know it, Sigma Global Funds. And the winners, where are the winners? Yes? King Al on Zoom, yes? King Al, yes, King Al on Zoom, and at Hot Wax 2. What names are these? Hot Wax 2 on Instagram. That's those are the winners for question 1. And the winners for question 2, Audrey Douglas on Zoom and Dario Bernard on Facebook. Okay, congratulations, Dario, and if you get back, but I don't know about a Hot Wax 2. Yeah? Anyway, there you have it, the winners, okay? Now, we must say thanks to our presenters this evening, Kathryn Rooney Vera of Bultic. Thank you so much, Kathryn. Excellent presentation, your information and your contribution, excellent. Thank you very much.
Thank you, sir. Thank you for having me.
Good. And to the Senior Deputy Governor of the Bank of Jamaica, Dr. Wayne Robinson. Thank you very much.
It was my pleasure.
I'm going to say something about you. In preparing to come here this evening, I read up a little about Dr. Robinson. And did you know that he joined the central bank out of school? It was his first place of employment. And he started in IT and then decided that he wanted to do economics. How long ago was that, Wayne?
I joined the bank May 1989.
May 1989. That's 33 years ago. And here he is now, Senior Deputy Governor of the Bank of Jamaica. Thank you very much. Good. And of course, the President and CEO of Sagicor, Christopher Zaka. Thank you so much for inviting us. Executive Vice President Sean Newman. Thanks to all the members, Jody Ann, all the members of the Sagicor family. Good. And congratulations again to our winners. And we want you to send us a direct message so that we make arrangement to get you your prizes. Okay? It has been indeed an insightful evening, a very informative evening. We have learned a lot about what's happening in our global community, our global village, bedeviled by turmoil. But we have the knowledge. Now we need the fixity of purpose to be smart about tackling the challenges that face us. Until next time, I am, or has been, your host, Cliff Hughes. Take care of yourself. Have a good evening. Bye.
Seaside Inn, this is Jillian. How may I help? Hold, please. Seaside Inn, this is Jillian. Hold, please. Hi, Mrs. Ashby. Yes, I'm just putting on the final touches to your necklace. Thanks for holding. Golden what delivery? Yao Zhong Wen, Xia, Ding Dan, Qing, and Golden what delivery?
There's working hard for your money.
Hold, please.
And there's making your money work hard for you. With as little as $500 or $50 US, get started with earning from Sigma Global Funds today.